14%. That is the number I want you to hold in your head for the next 20 minutes. Not the price, not the chart. 14%. Because that is how much of COMEX's outstanding silver contracts are actually backed by metal you can touch, weigh, and walk out the door with today. And in the last 30 trading days alone, that number has been falling fast. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos. In that time, I have watched a lot of supply crunches get talked about, and a lot of them amount to nothing. But every now and then, the data lines up in a way that makes me stop, check the source twice, and then decide we need to talk about it on camera. This week is one of those weeks. Everything I show you today comes from publicly available sources: the CME warehouse reports, the CFTC commitment of traders' data, the Shanghai gold exchange pricing, and more. I will name everyone as we go. If you have been looking for the kind of calm, data-first breakdown that does not ask you to panic and does not ask you to buy anything, hit the like button right now. It tells me to keep making these. And if you are not subscribed, now is the time, because what we are covering today is part of a bigger picture we are building week by week. 3 things you are going to understand by the end of this video. First, what the COMEX registered inventory number actually means, why it matters right now, and why 14% is not a headline to brush past. Second, what the $5 to $8 premium Asia is paying for physical silver tells us about where the real floor in this market sits. Third, how the 3 lanes framework reads this specific setup, and what the one thing is that I am personally watching this week. Before all of that, I owe you a return to last week's call. Last week I told you to watch the US dollar index at the 99.57 level. I said if DXY broke and held above that number, it would apply meaningful headwind pressure on metals, and we needed to see silver hold above $86 for the physical demand story to stay intact. Here is what happened. DXY tested that level this week on the back of Iran conflict safe haven flows, and silver did pull back, but it held. As of this morning, silver spot is trading at approximately $88.42s. The dollar pressure was real. The physical bid underneath silver was stronger. That is an important result, and it matters for how we read the setup going forward. Now let me show you why. Silver at $88 right now. 12 months ago, that number would have sounded like someone had been reading too many Substack newsletters. But here is the thing about this price. The price is almost the least interesting part of what is happening in silver right now. What is interesting is what is happening underneath the price, inside the vaults. Quick question before we go further. Are you seeing elevated premiums at your local dealer this week, or has spot premium normalized at your end? Drop that in the comments right now. The comment section here becomes a real-time sentiment tracker, and I read every single one. It genuinely matters for what we discuss next week. Let me explain what COMEX registered inventory actually is, because this is where a lot of the confusion starts. COMEX is the primary U.S. futures exchange where silver contracts trade. When you buy a silver futures contract, you are in theory buying the right to take delivery of actual physical silver at expiry. But COMEX has 2 categories of metal in its approved warehouses. There is eligible stock, metal that meets the quality and form requirements to be delivered, but is not actively earmarked for delivery. And then there is registered stock, the only category that can actually be delivered against an open futures contract. Think of registered as the live inventory on the shelf. Eligible is metal in the back room that the owner has not yet put on the shelf. Right now, according to the most recent CME warehouse report, registered silver sits at approximately 103 million ounces. That sounds like a lot until you put it next to total open interest, which sits near 429 million ounces. Do the division. 103 divided by 429 gives you approximately 24%, but registered against just the near-term deliverable contracts pushes that coverage ratio down to approximately 14%. 14%. That means for every 100 ounces of silver that futures contracts technically have a claim on, only about 14 ounces of immediately deliverable metal exist to honor that claim. The assumption baked into the market is that the other 86% of contracts will either roll forward, get cash settled, or close out before delivery is ever demanded. Most of the time, that assumption is correct. The question right now is what happens if it starts being tested at the margin. Here is the analogy that brings this to life. Imagine a hotel that has sold 429 room bookings for the same weekend, but only 103 of those rooms are actually made up, cleaned, and ready to go tonight. The hotel is betting, reasonably, based on experience, that most of the other 326 bookings will cancel, reschedule, or accept a voucher instead. Most of the time they are right. But if checkout day arrives and more guests than expected actually show up demanding their room, the system starts to stress very quickly. A 14% coverage ratio is the hotel realizing its cancellation rate assumption may be running out of runway. Now here is what makes this more than just a number to file away. According to the CME warehouse data, registered silver has declined approximately 23.1% over the past 30 trading days. That is a withdrawal of roughly 24.1 million ounces in a single month. I want you to sit with that for a second. 24 million ounces of physical silver pulled out of COMEX deliverable inventory in 30 days. If that drain rate holds, and I want to be careful here because withdrawal rates are not linear and they can slow or reverse, but if it holds, we are looking at registered inventory potentially exhausted within approximately 70 trading days. That number is not a prediction. It is a rate of change observation. But it is the kind of observation that changes how you pay attention to the next set of data. If you have stayed with me this far, what is coming in the next few minutes is the part that actually changes how you read this market, because the vault story in New York is only half of it. What is happening in Shanghai is the other half. The Shanghai Gold Exchange prices physical silver in yuan, but when you convert to dollars and compare to COMEX spot, something persistent and significant shows up. In recent months, according to Shanghai Gold Exchange data, physical silver in China has been pricing at a premium of approximately $5 to $8 per ounce above COMEX. This week, that premium sits near the upper end of that range at approximately $8. Now, before you run with that, premiums can reflect local taxes, import tariffs, financing costs, and market structure differences, not just pure physical scarcity. So I am not standing here telling you this single number is proof of a global shortage. What I am telling you is that when the world's largest physical consumer of silver consistently prices deliverable metal $8 above the Western paper market, that is a structural signal worth taking seriously. China's exchange requires actual delivery. You cannot cash settle your way out of a Shanghai contract. The $8 premium is what the market that requires physical delivery is willing to pay over the market that mostly does not. Here is what that means in practical terms. When that kind of gap persists, it creates an arbitrage incentive. Buy in New York, ship to Shanghai, collect the difference. And that arbitrage, if it is being executed, is exactly the mechanism that drains Western vaults. You are watching the output of that process in the CME warehouse data right now. If you know someone who has been watching silver this week and trying to make sense of the moves, share this video with them right now. This breakdown took time to put together, and the people who need it most are probably not the ones who searched for it. The macro picture adds a layer of complexity here that I want to be honest about, rather than ignore. The US dollar index is trading near 99.0 this week, having tested multi-month highs on the back of Iran conflict safe haven flows. The 10-year Treasury yield is holding near 4.10%, pulling back slightly from a midweek high near 4.16%, as energy-linked inflation concerns stay elevated. A strong dollar is structurally bearish for silver because it makes the metal more expensive in foreign currency terms, and it draws safe haven capital toward treasuries and away from metals. The fact that silver is sitting above $88 despite meaningful dollar strength is not nothing. It suggests the physical bid from industrial and Asian buyers is doing real work underneath the price. But I am not going to wave away the dollar headwind. It is real, it is present, and dollar momentum above 99.57 would be a genuine caution signal for anyone holding metals on margin. The geopolitical layer is straightforward to describe, but genuinely hard to model. The Iran situation has been driving the safe haven narrative this week. Gold at 5,194 is the cleaner beneficiary of that flow because gold's industrial demand footprint is smaller and its safe haven function is more established. Silver benefits, but with more noise, because silver has to carry both the industrial demand story and the monetary metals story simultaneously. World Gold Council data published this quarter continues to show central bank accumulation of gold reserves at a meaningful pace, and these are not traders. They do not check price charts every morning. When a central bank reallocates reserves into gold, that is a multi-year structural decision, not a tactical trade. The direction of that flow does not reverse on a week of dollar strength. De-dollarization is a decade-long structural process. It is not a Tuesday event, but the direction of travel is visible and documented. On the UK side, the London Bullion Market Association's vault data continues to show physical silver being moved rather than sitting static. For British investors holding silver in a SIPP, the combination of LBMA physical flows and Royal Mint demand figures, this quarter points to the same underlying theme as COMEX. physical appetite for silver is not softening. The Royal Mint has not published March figures yet, but February showed sustained retail demand for silver Britannias at a level consistent with the broader physical demand narrative. The industrial demand case for silver is worth keeping grounded in actual numbers rather than projections that sound exciting but fall apart on inspection. The Silver Institute's most recent supply and demand survey, which I pulled earlier this week, continues to show structural deficits in silver supply versus demand. Solar panel manufacturing is the headline story, and it is real. Photovoltaic cells use silver paste for electrical conductivity, and at the scale of current and projected solar rollout, the ounce per panel requirement adds up. But I am not going to give you a precise ounce per megawatt figure because that would be false precision, and you deserve better than that. What the data shows is the direction of demand. AI-adjacent hardware and EV power systems are real incremental consumers. The direction of industrial silver demand has not reversed. What is genuinely uncertain is whether thrifting, manufacturers finding ways to use less silver per unit, will offset scale. The honest answer is both forces are in play and the net is not yet clearly resolved. Silver is not like oil where you can watch it burn. It is hidden inside connectors, panels, and circuit boards, dispersed in tiny amounts across massive industries, and rarely recovered perfectly. That dispersion is itself a supply-side constraint that most people underestimate. All right, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1, the paper market. COMEX futures are showing near-term contango. Spot is priced below deferred contracts. That is technically normal, and by itself it does not scream crisis. But managed money, net long positioning, according to the most recent CFTC Commitment of Traders report, is not at historic extremes in either direction, meaning this rally has not been driven primarily by speculative euphoria. If anything, there is room for more speculative participation to enter, which can amplify moves in either direction. The coverage ratio at 14% is the number that keeps the paper lane interesting. Lane 2, the physical market. COMEX registered inventory down 23% in 30 days. Shanghai premium at $8. Royal Mint demand sustained. These are not soft signals. The physical lane is showing real, persistent, measurable appetite for metal at prices that 12 months ago seemed unreachable. Lane 3, macro. Dollar near 99 with upward momentum. Treasury yields elevated at 4.10%. Iran conflict adding geopolitical premium, but also potential for reversal if the situation cools. Gold at 5,194 acting as the cleaner safe haven vehicle. The macro lane is mixed, constructive in the geopolitical sense, headwindish in the dollar and rate sense. In 15 years watching currency and commodity markets, the times I have seen all 3 lanes align in the same direction, even briefly, have historically been some of the most significant moments in these markets. I am not saying we are there today. The macro lane is genuinely mixed. What I am saying is the physical and paper lane combination right now is the most interesting setup I have seen in silver in a long time. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One thing. The next CME warehouse report. Specifically, whether registered silver inventory continues declining or whether we see a stabilization or bounce. That report updates regularly, and the next meaningful read drops within the next few trading sessions. If registered inventory falls below 95 million ounces, that pushes the coverage ratio to a level where the conversation in institutional circles changes. If it stabilizes or bounces back toward 110 million ounces, it tells us the drain rate I described earlier was a shorter-term phenomenon rather than a sustained structural move. Those 2 outcomes have completely different implications for how the next few weeks develop. This is my one call for the week. John, FX Insider. On record, I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. Here is what needs to happen for the optimistic picture to develop. Physical demand from solar, EVs, and AI hardware continues to run hot. Chinese buyers maintain or increase their premium bids, keeping that east-west arbitrage alive and draining Western vaults further. COMEX registered stocks fall below the level where institutional participants start taking delivery risk seriously. The dollar peaks and rolls back below 98. In that scenario, the gap between paper price and physical reality forces a meaningful repricing higher. That is a coherent, data-supported case. Here is what needs to happen for the cautious picture instead. Dollar strength resumes and DXY pushes above 100. The Iran situation de-escalates faster than markets expect, pulling safe haven premium out of the metals complex. Speculative long positions unwind before physical demand can absorb the selling pressure, driving spot below $85 even as vaults continue draining. In that scenario, you get the frustrating situation where the physical story is playing out exactly as described, but the paper price does not reflect it, at least not yet, and paper is what shows up in your portfolio value. Both are genuinely possible right now. I have seen both happen in 15 years. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing in real time. The market will tell you. You just have to be watching the right things when it does. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the 2 questions. If you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you 2 things, and I genuinely want your answers, not just a thumbs up. First, if you are holding physical silver right now, what is the premium you are seeing at your local dealer or online compared to spot? $1 over? $3? $8? Put the number in the comments. Second, given the 14% coverage ratio we walked through today, do you think the paper market reprices to physical reality this quarter, or does the macro headwind from the dollar delay that by 6 months or more? Drop both answers below. The comment section here becomes a real-time sentiment tracker, and I read every single one. Subscribe because next week we are going into the CFTC commitment of traders' data in detail. I am going to show you exactly how to read managed money positioning in silver and gold as an early warning system. That is a skill worth having. And if someone in your life is watching their stack right now and feeling confused about what is happening, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.